Warning: why your insurance card is now a debt trap. Your insurance went up 27%, and you got less. Premiums up, deductibles up, denials up. Some carriers auto-adjudicate claims in 1.2 seconds. If a robot flags your code wrong, you don't just get denied, you get debt. Here's the part nobody tells you. 3 levers quietly set your price, stall your claims, and shift risk to you. By the end, you'll know how to cut 15 to 35% without getting denied, and how to stop the debt pipeline before it starts. Most people wait for renewal. Don't. The machine reprices you monthly and appeal windows close fast. We'll open it up, expose the incentives, and hand you the counter moves. Why you, why now? The urgency and the playbook we'll use. Okay, here's the thing. Insurance used to be a safety net. Today, it's a yield product. The goal isn't just covering loss. It's hitting combined ratio targets and delivering steady returns to owners and bondholders. When that flips, everything downstream shifts. Pricing, networks, prior auth, denials, and the fine print that decides whether your coverage activates at all. You feel it everywhere: home, auto, health, life. One claim that drags or gets downcoded can force a high-deductible hit, a medical credit card offer, and a balance that follows you into collections. That's not bad luck. It's an incentive map. What's accelerating it right now? 3 macro currents: climate and catastrophe repricing. Reinsurance rates and cat bonds filter into your property premiums and deductibles. Post-event surcharges spread losses forward, even if your house didn't flood. Medical inflation plus automation. AI adjudication and prior auth backlogs squeeze payouts. Soft denials and request more info tactics rely on abandonment, not accuracy. Rollups and private capital. Broker and TPA consolidation harmonizes prices upward, adds fees, and locks employers and households into narrower, higher friction networks. Here's our playbook so you're not a bystander. See the machine. We'll map the price engine, loss cost, reinsurance, expense load, target margins, and where brokers, MGAs, and PBMs skim. Once you can point to each layer, you can remove junk riders, eliminate wrong surcharges, and force re-rates. Beat the algorithm of no. We'll use file-proof claims tactics, timestamped photos, inventory logs, ICD/CPT precision, and appeal scripts that flip abandonment math. You'll trigger external review and escalation ladders that bypass the call center maze. Cut the debt pipeline. We'll align your deductibles with a cash buffer, shop cash pay medical rates ahead of care, and lock in pre-negotiated facility quotes. If financing is unavoidable, we'll structure it on your terms, not a 20% APR card. Build leverage. For employer plans, we'll lean on ERISA rights to get plan docs, claims files, and medical necessity criteria in writing. For home and auto, we'll pick carriers with bindable, pre-bind quotes and loss runs that erase phantom surcharges. Group power. Buying clubs, association plans, and captives can shift you from price taker to negotiated rate buyer. Transparent TPAs and pass-through pharmacy models remove spread pricing that bleeds your premiums. Think of insurance like a seatbelt that's become a toll gate. You still need it, but you shouldn't pay for upgrades you don't use or accept indefinite delays to pass through. Our job is to make the gate open when it should, at a fair price, with documentation that leaves no wiggle room. Everything starts now, not at renewal. Your records, your calendar, your evidence, that's your leverage. Ready? First, we pull apart the price engine so you can see exactly what you're paying for and where to take costs out without getting burned. The price engine, how your premium is really set. Let's open the hood. Every premium is a stack: loss cost, reinsurance, expense load, and a target margin that keeps the combined ratio where executives want it. Loss cost is the actuarial core. What similar risks have actually cost in claims, adjusted for your specifics. That number gets pressure from inflation, parts and labor, medical costs, and where you live. If your zip code just had a hail spike or your hospital market consolidated, loss cost inflates before you even touch coverage. Now add reinsurance, which is your insurer's insurance. When reinsurers raise rates after storm years or widen deductibles on their contracts, your carrier passes that through in 2 ways: higher base premiums and bigger catastrophe deductibles. That's why you'll see wind or hail deductibles quoted as a percentage of dwelling value instead of a flat number. One event becomes a 5-figure self-insured bill. Next is the expense load. Think claims handling, call centers, IT adjusters, and this is big distribution costs. If a broker or agency placed your policy, commissions and contingent bonuses are baked in. Contingents reward volume, retention, loss ratios, and growth, which quietly nudges steering toward markets that pay the broker more, even if a different carrier would be better for you. With private equity-owned distributors, the incentive to harmonize pricing and upsell add-ons only intensifies. Riders sound protective. Many duplicate what your base policy already covers or carry sublimits that don't move the needle. Finally, the margin. Carriers target a combined ratio below 100, claims plus expenses divided by premium. Miss it, and they re-rate classes, prune geographies, or tighten underwriting. Hit it, and they still may push for rate adequacy in underperforming segments. Translation: even clean risks can see increases if your cohort underdelivered on profit. Here's where the squeeze appears in the wild. Catastrophe models are recalibrating for secondary perils: hail, convective storms, wildfire smoke. If your roof is older or your area's frequency chart lights up, expect a surcharge or coverage carvebacks. Cosmetic damage exclusions, actual cash value on roofs, special deductibles. In auto, repair severity went up with parts costs and sensor-laden bumpers. If your vehicle has advanced driver assistance, one fender bender can look like a surgery bill. The renewal trap hides in defaults. You get a no material change letter, the premium is up 12%, and 3 new endorsements slide in. Bundling discounts mask the real price of each line. In health, network shifts and formulary changes quietly convert your in-network to not here anymore. In property, water backup endorsements flip from included to sublimited. If you don't audit line by line, you pay for less. So, how do you claw back 15 to 35% without getting underinsured? Start with a coverage audit. List exclusions, sublimits, and coinsurance clauses that punish you at claim time. Drop duplicate riders. Roadside assistance you already have from the automaker, identity theft you get via a bank, device protection that overlaps warranties. Reclaim dollars for real risk. Second, shop the market the smart way. Use an independent broker, and also pull at least one direct carrier quote. Ask for bindable quotes, not indications, so you can pit final numbers. Require a coverage matching worksheet. Same dwelling limit, perils, deductibles, sublimits. Apples to apples stops the cheaper because it's weaker trick. Third, attack reinsurance-driven surcharges. On home, ask for a roof schedule option. Higher roof deductible in exchange for lower premium. Only if you've budgeted for that risk. If your roof is newer, push back on ACV settlements. Replacement cost often prices cheaper than you think when you show proof of age and material. On auto, raise comprehensive and collision deductibles strategically while adding a repair fund. Net savings often outweigh the extra out-of-pocket on unlikely events. Fourth, force a re-rate with your loss runs and records. For home and auto, request a 5-year loss run and MVR/CLU data. Challenge phantom losses, closed without payment entries, and incorrect drivers or garaging. A single bad data point can add hundreds. For small group health, ask your broker for the claims experience and high-cost claimant impact. If one outlier drove a spike, level-funded or captive options can price truer to your group's baseline. Fifth, calendar your renewals. Stagger policies so you're not shopping 3 lines in the same month when time is scarce. Set a 60 to 90-day pre-renewal window. That's when underwriters still have appetite and brokers still have time to advocate. Last-minute quotes come with panic pricing. Watch the broker spread. Ask how your broker gets paid, base commission, and any contingent. Then request options with lower comp markets and fee-based placement. When the broker sits on your side of the table, transparent fee. They're freer to push carriers on price and terms. If they won't disclose, that's your shopping signal. Now the PE-owned distributor angle. Rollups often standardize offerings. Great for them, expensive for you. If your brokerage changed hands, compare last year's coverage graph to this year's. Did they move you to house-favored carriers? Did admin fees appear? You're allowed to move your business, even if the same producer calls you. Loyalty is fine, just make them earn it. Bottom line, premiums rise when loss costs, reinsurance, and expenses stack, then margin targets seal the lid. Your countermoves are documentation, timing, and coverage precision. Strip waste, fix data, demand comparables, and use deductibles like levers, not landmines. Because every dollar you prevent from entering the rate base of your policy is a dollar you keep for an emergency fund that actually protects you when a claim hits. The algorithm of no, auto denials, and adjudication drift. Now the part you feel after the bill, when you file a claim. Here's what actually happens behind the portal. Your submission hits a sorting layer that isn't reading your story, it's scanning for patterns. Timing, codes, modifiers, phrasing, provider type, prior authorization status, and historical utilization. In milliseconds, automation assigns a path: pay, pay less, pend, or deny. Most people think a medical director studies each case. In reality, rules engines and scorecards clear the majority before a human ever looks up. Soft denials are the first wall. The notice says need more information or not enough documentation to adjudicate. That sounds fair. It's designed for drop-off. Insurers know a chunk of people won't resubmit or will miss a deadline. That abandonment saves payouts without saying no. In property claims, you'll see coverage under review while they request photos you already uploaded, logs you've already sent, or contractor estimates with extra formatting. Each round restarts the clock. In health, pens for missing chart notes, incorrect place of service codes, or missing modifiers push the claim into a second pass at lower priority. Downcoding is the quiet squeeze. A provider bills a level 4 visit. The system maps it to level 3. A surgical code bundles into a cheaper family. A laceration repair is recast as simple instead of intermediate. You won't see denied. You'll see paid at a reduced rate. For you, that means higher coinsurance against a lower allowed amount, more out-of-pocket for less care on paper. In dental, periodontal scaling becomes adult prophylaxis. In pharmacy, brand medically necessary becomes therapeutically equivalent generic, triggering step therapy you never agreed to. Prior authorization is delay as strategy. The criteria live in manuals you rarely see. Medical necessity is defined by proprietary guidelines, not the clinical notes you read. Requests penned for peer-to-peer reviews that can be scheduled next week. And approvals arrive with expiration windows too short to align with operating rooms or specialist calendars. If you cancel and reschedule, you restart. If you miss the window, the case closes. Most people think the fix is yelling. The fix is documentation that forces a peer, with a deadline and citations in the policy's own language. Appeals math is simple and brutal. Stage 1, internal review by the same entity that denied you. Stage 2, second-level internal review, often by a cubicle over. Stage 3, external review, where wins often happen, requires you to survive the first 2 cleanly and on time. Every missed form, date, or magic phrase pushes you back a square. So we flip the flow. File-proof your claim at the start. For property, time-stamped photos, serial numbers, inventory spreadsheets with model numbers, and videos panning rooms before loss. Keep receipts in a cloud folder. Log phone calls with dates, names, and promises. For health, precision on ICD-10 and CPT/HCPCS codes, correct modifiers, place of service, and linking diagnosis to procedure in notes. If it's complex, ask your provider's billing team to add the supporting documentation up front. Progress notes, conservative therapy tried, radiology reports with measurements. Use the payer's policy against the algorithm. Request the plan document, summary plan description, and clinical policy bulletins for your procedure or drug. Highlight the criteria you meet. In your submission, mirror their language. Meets criteria X, Y, Z as defined in Policy ABC Section 3.2. That converts clinical opinion into compliance. If it's employer-sponsored, ERISA gives you the right to plan documents, claims files, and relevant documents relied upon in denial. Ask in writing, certified mail. Missed deadlines by the plan can trigger deemed exhaustion. That moves you to external review faster. Set appeal timelines on a calendar with alarms. Stage 1 appeal. Submit within the window, cite policy sections, attach all evidence, and state, I request the entirety of the claim file, internal notes, and any external reviewer reports relied upon. Demand confirmation of receipt. Stage 2. Repeat with additional evidence and point out process failures, missed response times, failure to consider new evidence. Stage 3. Trigger state external review, or federal, if ERISA preemption applies. External reviewers often overturn when the record is complete and policy criteria are clearly met. Use escalation ladders. For medical, physician-to-physician peer review with scripts. Doctor-to-doctor peer requested per policy, requesting reviewer with specialty match. Clinical criteria ABC at hand. If denied, escalate to a medical director. For network, escalate beyond the call center, provider relations, then market president. For property, desk adjuster, senior adjuster, field manager, then claims leadership. Keep everything in writing. Summarize calls by email to the adjuster and CC your file. Exploit timely access rules. Many states cap response times for prior auth and urgent appeals. If a deadline is missed, request automatic approval per regulation citation. In pharmacy, invoke continuity of care, temporary fills during transitions. In hospital settings, ask for concurrent review with bedside clinicians present. Force real-time decisions instead of retroactive denials. Document bad faith patterns. Repeated requests for documents already provided, contradictions between EOB and denial letter, missed statutory timelines, or changing reasons for denial at each stage. Build a pattern memo. It's leverage for regulator complaints, employer HR escalation, self-funded plans hate noise, or counsel if needed. Last piece, use clarity to shorten the game. The algorithm exploits ambiguity and fatigue. Replace both with evidence, policy citations, and clocks you control. Once you speak their language, no becomes prove it, and prove it is a fight you can win. Betting on disaster, cat bonds, reinsurance, and your bill. Everything changes when you see the second balance sheet, your insurers. They don't simply take your premium and hope for a calm year. They buy protection too, and the price of that protection flows straight into your renewal. Start with the reinsurance cycle. When big losses hit, hurricanes, hail swarms, wildfires, reinsurers raise rates and push up retentions. Your carrier pays more for a thinner safety net, so two things happen. Base premiums climb and event deductibles swell. That's why wind and hail deductibles shift from $1,000 to 1 to 2% of dwelling value. The reinsurance bill gets socialized through your policy. Then there's the other safety net, catastrophe bonds. Think of a cat bond as a disaster swap. Investors collect a rich coupon as long as triggers don't fire. If a defined event hits certain thresholds, principal funds your carrier's claims. Yields were eye-popping recently, high teens in 2023 to 2024, and issuance set records. Great for investors, but here's the part most people miss. Your premium helps pay those coupons. Whether the bond triggers or not, you fund the ticket to ride. Triggers matter. Traditional cat bonds use parametric triggers. Wind speed at a station, quake intensity, modeled loss above X. That's fast money for carriers. But speed cuts both ways. If the instrument doesn't trigger, say the wind measured 2 miles per hour short across the box, your insurer still ate losses in your region, and they still need to recoup. Cue post-event surcharges and midterm filings to restore capital. You pay now and later. Climate isn't a headline here, it's pricing geometry. Secondary perils, severe convective storms, hail, flood, are repriced with finer granularity. Models recalibrate zip by zip, roof by roof. If you're in a hot cell, the reinsurance load assigned to your cohort spikes, even when your individual risk looks tidy. That's how you end up subsidizing a county over, and it's why the cleanest claim history doesn't always save you. After a major event, watch for the recoup sequence. First, your carrier's cat cover may attach high. Losses below the threshold are theirs. Second, if the bond didn't trigger and traditional cover exhausted at a high layer, your carrier plugs the gap with surplus and debt. Third, regulators often allow catastrophe recovery, riders over the following terms. None of those steps mention you, but each shows up in your bill. Moral hazard comes up a lot. Are investors betting against your house? Practically, no one roots for catastrophe, but incentives do diverge. Portfolios prefer stable triggers, high coupons, and diversified peril baskets. Carriers prefer quick, certain payouts. Regulators prefer solvency. You prefer affordable, reliable coverage. When those preferences collide, the easiest lever to pull is your premium and your deductible. So, what do you do with this? You can't price reinsurance, but you can change how reinsurance prices you. Reduce your modeled loss, not just your aesthetics. Underwriters map roof age, materials, attachment, and mitigation. If you've upgraded roof, underlayment, or secondary water barrier, document it. Bring proof, permits, invoices, photos. Ask your agent to request a roof schedule credit or a reduced roof factor based on material and age. Separate peril deductibles strategically. Consider higher wind/hail deductibles paired with a dedicated reserve, while keeping all other perils lower. That can cut the reinsurance load allocated to your policy without turning every kitchen leak into a budget crisis. Challenge geography creep. If your address picked up a convective storm surcharge after a hail year that missed your census block, ask for the map. Some carriers will re-rate when you supply roof condition evidence and local loss runs. Precision beats pleading. Use bindable comparables. When you pick carriers, demand bindable quotes with the same peril deductibles and special sublimits. If one carrier's cat load is materially lower, show that to your incumbent and request a re-rate. Underwriters compete when you hold apples to apples. Time your roof like a refinance. In many markets, re-roofing with impact-rated materials immediately shifts your modeled loss and unlocks. Replacement cost on roof again. Ask for an off-cycle endorsement and midterm premium adjustment. Don't wait 11 months to capture the credit. Expect and plan for recoup riders. If your state allows catastrophe recoupment, earmark that line item when it appears and offset it with higher deductibles you've pre-funded. The discipline is the protection. Health plans feel this too quietly. Parametric drought, wildfire smoke disruptions, and utility failures create surge costs that self-funded plans and stop-loss carriers price the next year. Employers can blunt it with disaster continuity planning, backup locations, telehealth capacity, refrigeration protocols, because avoided surge is avoided reprice. Here's the plain language. The global safety nets your insurer buys are not abstract. They're a conduit from Wall Street to your mailbox. You won't change the cycle, but you can narrow the target painted on your address and reclaim dollars the models don't deserve to collect. That's leverage you control. Mitigation with receipts, peril-specific deductibles aligned to cash, and comparables that force underwriters to sharpen the pencil. And when the surcharge letter lands after the next storm 3 counties away, don't rage, re-rate. The insurance-to-debt pipeline, deductibles, medical cards, and financing. This is where a premium increase turns into a balance you carry for months. High deductibles were sold as skin in the game. In practice, they're crisis loans you extend to yourself at the worst possible moment. Coverage doesn't really start until you've drained cash you needed for everything else, and the gap gets bridged by plastic with medical branding and double-digit APR. Start with the structure. A $6,000 family deductible means the first $6,000 of medically necessary care comes from you. If the plan has coinsurance after that, you're still on the hook for a percentage until you hit an out-of-pocket max that can sit north of $14,000. One emergency room visit plus imaging plus a specialist consult can eat half the deductible in a weekend. That's before pharmacy tiers, facility fees, and separate deductibles for out-of-network accidents. Enter the sales pitch at checkout. We partner with a healthcare financing card, interest-free for 6 months. Sounds helpful. Read the terms. Many medical credit cards use deferred interest. Miss the payoff window by 1 day, and they backcharge interest on the entire original amount at 20% plus APR. Providers like these programs because they offload collection risk immediately. You leave with a swipe, they get paid, and future you inherits compounding. Hospitals also push in-house payment plans. Some are fair, 0 interest, 12 to 24 months, no hard credit pull. Others kick the debt to third-party financiers with junk fees and acceleration clauses. A late payment can collapse the plan and send the full balance to collections. Ask 3 questions before you agree. Is there interest? Who owns the paper after day 30? What happens if I miss 1 payment? Get the answers in writing on letterhead. Out-of-network traps multiply the pipeline. You check in at an in-network hospital and meet an out-of-network anesthesiologist or radiologist you didn't choose. Surprise balance bills still happen despite reforms, especially with facility-based providers and air ambulances. Your insurer applies out-of-network deductibles or lower allowables, leaving you a balance you never planned. Providers then offer financing on the spot, again, at rates that belong on a retail card, not a medical necessity. Pharmacies at a parallel lane. The plan denies a brand drug after step therapy. You pay cash to avoid a flare, and the pharmacist suggests a finance option integrated into the point of sale. That keeps you medicated today while turning adherence into revolving credit tomorrow. There's a better route. Ask for pharmacy cash prices, discount networks, manufacturer copay cards, and patient assistance eligibility before you swipe. Often, Cash beats the plan's negotiated price on generics, and manufacturer programs bridge brand costs without interest. Property claims have their own financing flavor. A water leak hits, the adjuster is slow, contractors want deposits, and a convenience loan is baked into the restoration contract. You sign to get crews moving. Weeks later, the claim pays less than expected, downcoding of line items, depreciation holdbacks, cosmetic exclusions, and you're repaying a balance on materials you thought were covered. Avoid this by separating scope from financing. Get a written, adjuster-agreed scope of loss first. If you must bridge cash, use a low-rate personal line you control, not a contractor's captive loan with fees tied to the invoice. Here's how you break the pipeline before a claim. Align deductibles to cash. If your family can truly cover $2,000 without debt, set deductibles near that number and bank the premium savings difference automatically into a separate account every month. Treat it like a bill. Label it deductible reserve. When the inevitable happens, you spend your reserve, not a future, at 22% APR. For home and auto, pair higher deductibles with a dedicated repair fund and strict vendor vetting. No same-day financing, no bundled warranties you didn't price. For health, pre-shop big care. Call hospitals and imaging centers and request the cash price and the insured price for the CPT code you need. Ask for a prompt pay discount in writing. In many markets, cash or prompt pay beats your plan's allowed amount once you factor deductibles, and you avoid financing altogether. If you go this route, verify how the provider will submit or not submit the claim so you still get credit toward your deductible if that matters to your yearly plan math. When financing is unavoidable, structure it on your terms. Avoid deferred interest cards. Compare a credit union personal loan, a % promotional card you control, and an actual hospital % plan with no acceleration. Pick the option with transparent amortization, no retroactive interest, and hardship provisions in writing. Then automate payments from your dedicated medical fund so you're not juggling dates. None of this works if you can't predict the bill, so fix accuracy first. Request itemized bills and medical records for any 5-figure statement. Audit line items, duplicate charges, wrong modifiers, upcoded evaluation levels, facility fees for services delivered in office suites. Dispute in writing within the window, and demand a corrected claim submission before you agree to any plan. Every $100 you remove here is $100 that never compounds. Last step, set household rules. No signing at point of service without a written estimate and the options above. No contractor financing. No medical card applications without a review period. Every debt proposal gets a cooling off window. You're not denying care, you're denying expensive speed. That's how you keep the card in your wallet from turning into a bill you resent every month. Consolidation, private equity, roll-ups, and the cost creep. Everything we've covered so far gets sharper once you see who owns the pipes between you and the carrier. Over the last decade, private equity moved into brokers, third-party administrators, TPAs, dental/vision networks, urgent care chains, pharmacy benefit managers, PBMs, and physician management groups. Each layer adds fees, narrows your choices, and raises the friction you feel when you try to use what you paid for. Here's how the Rollup works. A fund buys a regional broker, bolts on smaller agencies, standardizes compensation and technology, and harmonizes pricing. On paper, that's efficiency. In your renewal, it's fewer markets shown, more preferred carrier placements, and riders bundled by default. Contingent commissions, bonuses paid for volume, retention, and target loss ratios, quietly steer where your policy lands. When a consolidator controls your producer's tech stack, product list, and compensation, independent gets tight. TPAs and network vendors follow the same script. A PE-backed administrator promises employers lower costs through carved-out services, prior auth technology, utilization management, network leasing. Each contract has a per-claim fee, a per-member fee, or a savings contingent cut. Stack 3 or 4 layers, and the plan pays more to manage claims than to pay them quickly. The playbook rewards friction. Every touch is revenue. PBMs are the most visible extraction layer. Spread pricing, charging the plan more than the pharmacy gets reimbursed, and rebate chasing, favoring drugs with higher manufacturer kickbacks. Inflate what you and your employer spend while your copay floats on a list price no one actually pays. When PBMs are owned by insurers or PE platforms, formulary decisions become profit centers. Prior auth and step therapy expand not only to manage use, but to capture fees at each appeal step. Provider rollups hit your out-of-pocket differently. Dental and vision chains standardize codes, upsell add-ons, and keep most services in-house. Urgent care platforms push proprietary lab panels. Physician management groups negotiate rates with leverage, then funnel referrals to owned ancillaries. Your in-network visit turns into a facility fee add-on, a branded diagnostic, and a balance that eats your deductible in one afternoon. Vendor lock-in is the moat. Prior auth software, EDI clearinghouses, revenue cycle tools, and payer portals all tie to the same parent companies. Employers and small plans find it hard to switch without breaking eligibility feeds, pharmacy integrations, or data warehouses. Once locked, fees ratchet. You see it as admin increases folded into premiums or as new plan features that look suspiciously like the old ones with different names. Employers get squeezed into a corner. Carriers pitch savings via narrower networks and tighter utilization rules. Brokers, often owned by Rollup platforms, present market checks that rotate among a short list of favored carriers and TPAs. Meanwhile, the employer contribution strategy shifts deductible risk to employees, who then discover that denied claims and odd formulary changes are now their family's problem. The plan looks cheaper, the household pays more. Here's the part nobody tells you. Your premium dollars fund management fees you never see. Funds extract 2% on committed capital and 20% of upside from the platforms that sell you benefits. Those platforms also pay interest on debt used to buy your broker, your TPA, your urgent care network. Debt service becomes SG&A. SG&A becomes trend. Trend becomes your renewal. So, how do you counter a market structured to make switching hard and fees invisible? Start with disclosures. Ask your broker for a written compensation statement, base commissions, overrides, contingents by carrier, and any additional marketing allowances. Request service-level agreements that specify marketing to a minimum number of carriers, deliver coverage equivalency grids, and include a no-steering clause. If they push back, you found your leverage. For PBMs, demand pass-through contracts. No spread, full rebate. Transparency, and a guaranteed audit right with claims-level data. Add a lowest net cost formulary requirement and a pharmacy performance program that rewards outcomes, not brand loyalty. If your employer can't pry that from the incumbent, carve out pharmacy to a transparent PBM or add a cash price adjudication option so members can use discount networks and still accumulate toward deductibles. On medical networks, ask for open access tiers and site of care redirection that actually lowers costs for members. Imaging and infusion moved out of hospital settings can cut bills by 60%. Tie administrator bonuses to member net savings and clinical outcomes, not raw denial counts. If your TPA can't separate denial metrics from performance pay, look for one that will. For dental and vision, compare direct pay cash pricing against insurance allowances. Many Rollup chains price cleanings and lenses higher to capture plan maximums. A low-premium plan plus cash shopping frequently beats a rich plan with narrow networks. Ask providers for written cash quotes and lab choices before you swipe. Finally, create exit ramps. Build a renewal calendar with 120-day milestones, data extracts scripted, and a fallback TPA or carrier scoped. Require ownership change notices in vendor contracts that trigger a no-penalty termination window. Put a most favored clause in so your plan gets any lower fee of vendor offers within a year. Ports in the storm matter when your vendor sells or rebrands. Consolidation isn't going away, but opacity is optional. You break cost creep by forcing daylight into compensation, shifting incentives to net savings, and keeping a live path out of any lock-in. That's how you turn a Rollup's favorite customer, silent and sticky, into the one they price sharp and treat first. Personal defense. Cut costs without getting burned. Let's turn this into moves you can execute this week without nuking coverage or tripping claim landmines. Start with a coverage audit that looks for traps, not trophies. Pull your declarations pages and plan summaries. Circle exclusions, what's never covered, sublimits, tiny caps that surprise you, and co-insurance clauses, you pay a percentage after deductible. On home, watch for cosmetic hail exclusions, ACV roofs, water backup sublimits, mold caps, ordinance or law gaps, and personal property set at actual cash value. On auto, check OEM parts endorsements, glass deductibles, and rental reimbursement limits. On health, list prior auth triggers, tiered networks, and separate pharmacy deductibles. Now remove waste. Riders that duplicate what you already have go first. Roadside you get from the automaker, ID theft via your bank, cell phone coverage via your card, travel medical bundled with your premium card. Shift those dollars to meaningful gaps, ordinance or law, water backup, equipment breakdown, higher liability limits, and umbrella. The test is simple. If a loss happens tomorrow, will this rider actually write a check that changes the outcome? Next, shop smart. Use an independent broker, and also snag at least one direct carrier quote. Demand a coverage matching worksheet. Same limits, perils, deductibles, sublimits, and endorsements. Apples to apples prevents a cheaper but weaker switch. Ask for bindable quotes, not indications. Bindable is a number that survives underwriting. Indication is a tease. Give underwriters ammunition. Roof age and material, updates to electrical/plumbing/HVAC, security and water sensors, and any wildfire/defensible space or wind mitigation. Proof shifts price. Raise deductibles strategically. The math: increase comp/collision deductibles on auto and the all perils deductible on home to the highest number you can truly cover from cash. Then auto park the premium savings in a dedicated repairs and deductibles account. That's not austerity. It's self-insuring the small stuff and buying protection for the big stuff. Pair higher deductibles with a repair fund rule. No contractor financing, no same-day signatures, scope in writing first. On health, build a split strategy. If your employer offers a high-deductible plan with an HSA and also a PPO, run a 2-year total cost calculation. Payroll deduction plus expected out-of-pocket minus HSA tax advantages. HSAs are triple tax advantaged and portable. If the premium delta is large, the HSA path often wins. Either way, pre-shop care. Before imaging, procedures, or infusions, ask for CPT codes, then call multiple in-network facilities for insured and cash prices. Many hospitals will quote prompt pay discounts that beat plan rates when you're under the deductible. Get it in writing and clarify how they'll submit, so you still receive deductible credit if you need it. For prescriptions, add a cash lane. Ask the pharmacist for the cash price. Check discount networks and price manufacturer copay cards or patient assistance. Request dispense as written, only when clinically required. If step therapy is inevitable, ask your prescriber to document failed alternatives upfront to short-circuit denials. For recurring brands, connect with the manufacturer hub before renewal season. Locked-in support beats scrambling. File-proof your future claims now. For property, build a home inventory with photos and serial numbers and store it off-site. Add time-stamped videos of each room twice a year. Keep roof, appliance, and system invoices handy. Install inexpensive leak sensors and a monitored shutoff if feasible. Documented mitigation helps both pricing and claims. For auto, photograph all 4 sides, the VIN and mileage at each service. For health, store explanation of benefits PDFs, itemized bills, and clinical notes for any big episode. Label your folders by date and category. Master the first phone call. When a loss hits, you want a clean file. I'm reporting a claim for event. Here are photos, inventory, receipts, and a contractor scope prepared to Xactimate standards. Ask for the claim number and adjuster email on the call. Summarize by email the same day. For health, when prior auth is required, ask for the clinical policy bulletins, mirror their criteria in your documentation, and set the clock. This is urgent per state timely access rules. Please confirm receipt. Appeals have a script. Stage 1. Cite policy sections, attach evidence, and request the full claim file and internal notes. Stage 2. Add any missed records and point out timeline misses. Stage 3. Trigger external review, state for fully insured, federal for ERISA. For employer plans, send ERISA document requests by certified mail. If deadlines are missed, you can deem internal appeals exhausted and move forward. Put the dates on your calendar before you need them. Clean up your data. Request your CLUE and MVR reports, correct errors and closed without payment entries. For home and auto, pull 5-year loss runs and challenge anything incorrect. One phantom claim can cost more than an hour of paperwork. For small group employers, get aggregate claims data from the broker. If a single outlier drove renewal shock, explore level-funded or captive models that price to your group's norm. Use network escalation ladders. For health, Ask your doctor's office to initiate peer-to-peer with a specialty-matched reviewer. Have them reference your policy's criteria line by line. If the call goes nowhere, escalate to medical director, then plan sponsor HR for employer plans. For property, move from desk adjuster to field supervisor to claim leadership when material issues stall. Always summarize by email and request confirmations. Keep vendors honest. Require written scopes, line item estimates, and no financing clauses. For mitigation, ask for photographs and moisture logs daily. For rebuilds, separate emergency services from repairs. Don't sign a combined work authorization. For medical, ask for itemized bills with CPT/HCPCS and revenue codes. Dispute duplicates and level creep before you agree to any payment plan. Finally, calendar leverage. Set 90-, 60-, and 30-day renewal checkpoints. Stagger lines so you're never shopping 3 at once. Set quarterly coverage and care reviews. Update mitigation, refresh inventories, and pre-negotiate any elective care. Discipline beats drama. This isn't about playing lawyer. It's about turning insurance back into a tool that works when you need it and costs what it should when you don't. Offensive moves. Force fair pricing and faster approvals. Now that you've built your defense, flip the leverage. Offensive moves change carrier behavior because you're triggering rights and comparisons they can't ignore. Start with employer plans. If your coverage is employer-sponsored, ERISA is your power tool. Send a written request to the plan administrator for the summary plan description, the full plan document, all clinical policy bulletins relevant to your issue, and the entire claim file, including notes, guidelines, and reviewers' credentials. Use certified mail. ERISA imposes deadlines. Missed timelines can deem internal appeals exhausted, letting you jump to independent external review faster. In your appeal letters, mirror plan language and cite sections. Replace emotion with compliance. Meets criteria A, B, C per policy X section 3.2, request overturn. Trigger external review early where law allows. For fully insured plans, states run independent review organizations. For self-funded plans, invoke the federal external review process. Ask for an expedited review if a delay jeopardizes life, function, or a scheduled surgery. Demand a specialty-matched reviewer. Attach literature and your doctor's letter that maps findings to the plan's criteria. When the file is complete and citations are clean, overturn rates jump. Use the network escalation ladder with timers. For prior authorization stalls, schedule physician-to-physician peer review within 48 hours and request a physician of the same specialty. If that fails, escalate to a medical director and log every missed deadline. State timely access rules cap response times. Missed clocks convert to approvals in some jurisdictions. When calls end, email a summary, date, participants, policy citations, and commitments. On pricing, force comparables. For home and auto, request bindable quotes with matched coverage. Same limits, perils, deductibles, sublimits. Present at least 2 bindables to your incumbent and ask for a re-rate. Underwriters sharpen pencils when you show them real alternatives, not vague indications. Attach your mitigation proof, new roof invoices, wind or wildfire hardening, water sensors, to justify credits. Ask specifically for roof factoring relief, replacement cost reinstatement, and named peril carvebacks removed. Demand loss runs and purge bad data. Pull 5-year personal lines, loss runs, and challenge closed without payment entries and phantom claims. Ask your agent to resubmit to carriers once corrections post. For small employers, get de-identified claims data and high-cost claimant impact. If one outlier drove renewal shock, quote level funded or captive options priced on your group's baseline, not community panic. For auto and property claims, speak the adjuster's language. Submit Xactimate formatted scopes with line item detail, photos embedded, and code references. When an estimate is short, respond with a line-by-line supplement, not a complaint. Invite the carrier's preferred contractor to meet your contractor on-site. Reconcile scopes live. If depreciation is held back, provide completion photos and invoices immediately. Speed earns checks. Document bad faith patterns as you go. Keep a pattern sheet of missed deadlines, shifting denial reasons, duplicate document requests, and contradictions between EOBs and letters. After 2 or 3 documented issues, file a concise regulator complaint with attachments. Plans and carriers respond when a regulator asks for the file. CC Employer HR for self-funded plans. Noise at the sponsor level moves mountains. For pharmacy, pressure the PBM with lowest net logic. Ask your plan or HR to require a lowest net cost formulary and pass-through rebates. In your own case, request a medical exception with clinical citations and failed step therapy evidence bundled. Ask for a temporary supply during review under continuity of care rules. If denied, price cash with discount networks and manufacturer programs. Then submit your lower net with receipts and ask the plan to adjudicate at that rate or reimburse the delta. Pre-bind quotes before you shop a home. If you're moving, secure bindable home/auto quotes tied to the address, roof age, and mitigation proof before you sign. Hand those to your lender and current carrier. Pre-binding gives you rate leverage when timelines are tight. For health procedures, create a choice set. Get 3 in-network facility quotes with CPT codes and documented out-the-door patient estimates, plus an equivalent cash quote. Send the lowest net to your plan's member services, asking for a pre-service coverage determination at that facility. Plans hate paying more than a documented lower option. Some will issue a one-time exception or steer you with enhanced benefits. Don't let denials stall care. Ask your physician to code urgent where clinically justified. Request an expedited appeal and an interim authorization for conservative alternatives, imaging labs, so the care path keeps moving while the final decision lands. Speed reduces complications. Complications explode costs. Insurers understand that math. Finally, make your calendar a weapon. 90 days before renewal, request re-rates, loss runs, and plan documents. 60 days out, present bindables. 30 days out, lock the best option. Put appeal deadlines, prior auth clocks, and regulator timelines on one shared calendar. Offense is discipline written down. You can't change their incentives. You can force them to respond to yours, documents, deadlines, and dollars they can see. Group power, buying clubs, captives, and co-op models. Everything gets easier when you stop buying insurance alone. One household is a price taker. 50 households, a trade group, or a set of small employers with a shared risk profile can negotiate rates, service levels, and rules that carriers actually respect. That's the point of buying clubs, captives, and co-ops. Aggregate clean risk, demand transparency, and keep savings inside the group instead of bleeding it into middle layers. Start with association plans and buying groups. If you're a small business, freelancer, or part of a professional guild, check whether your association sponsors group health, dental, vision, or property programs. You want 3 things: documented underwriting concessions, e.g., reduced participation requirements or composite rates, a rate stabilization reserve that cushions bad years, and real governance. Member voting on plan changes, not a vendor's advisory board. Ask for the fee stack in writing. Admin PMPM, network access, care management, PBM spread. If they won't show it, move on. Captives are the next rung up. A captive is an insurance company owned by its insureds. You and other members pay premiums into a licensed entity, retain predictable layers of risk, and buy reinsurance above that. In good years, underwriting profits stay with the group as dividends or surplus credits. In tough years, your capital absorbs the hit, but at a level you've modeled. The key is discipline. A captive without tight underwriting and claims management is a fancy leaky bucket. Here's where captives work best: homogeneous risks with decent loss histories. Think contractors with strong safety programs, professional firms, mid-sized manufacturers, or medical groups. You need 5 pillars: actuarial feasibility, credible loss projections, conservative capitalization, claims governance, TPA with performance guarantees, reinsurance at the right attachment, and exit rules that don't trap members. Don't chase headline savings. Chase control, data access, loss control dollars spent where you need them, and renewal math you can predict. Self-funded with stop-loss is the health version. Employers fund claims as they occur and buy stop-loss for big hits. Level-funded plans smooth cash flow by bundling stop-loss, admin, and a claim allowance into a fixed monthly bill with a year-end settlement. Guardrails matter. No laser clauses that target sick members at renewal, aggregate attachment points set by credible actuaries, and a TPA contract that gives you raw claims data, not dashboards. Add a plan document you actually own, so you, not a vendor, decide medical necessity definitions and appeal standards. Co-ops take the we own it logic further. A health co-op or benefit trust pools small employers under one governed entity. Success looks like open networks with site-of-care redirection, hospital outpatient to freestanding where safe, pass-through pharmacy benefits, no spread, full rebate, and incentives that pay members to choose lower net options. Savings feed a reserve that stabilizes rates instead of vanishing into carrier margins. The trade-off: you'll spend time in governance meetings. That time buys veto power over the nonsense we've been fighting all episode. Pharmacy is ripe for group power. A pass-through PBM serving a captive or co-op prices at acquisition cost plus a transparent fee. Rebates flow 100% back monthly. Formularies are lowest net cost, not highest rebate. Members see cash price adjudication. If a discount network beats plan price, you pay the lower figure and still accumulate toward deductibles. Every quarter, audit 10 high-cost NDCs and verify spread equals 0. If you smell games, you have the contract rights to switch. Property buying groups help too. Neighborhood wildfire councils, coastal wind pools, or trade associations can secure mitigation credits and aggregated deductibles no single policyholder can touch. The move is simple: organize inspections, certify mitigation standards, roof class, ember screens, defensible space. Then present a roster to underwriters with bindable commitments. Underwriters price evidence. Your group gives it to them at scale. Governance is the moat. Any group model lives or dies on rules. Bake in conflict of interest policies, open RFPs for vendors every 3 years, member votes on major plan shifts, and clawbacks if a vendor misses service level guarantees. Put most favored pricing in every contract. If your TPA or PBM gives lower fees to another client, you get them automatically. Require portability. Data extracts scripted and ready if the group changes vendors. Who shouldn't do this? Groups with chaotic losses, no appetite for meetings, or leadership that treats reserves like piggy banks. A captive or co-op without reserve discipline is painful on the way up and brutal on the way down. If you're not ready to read monthly financials and hold vendors to metrics, stick to a transparent, fully insured option and join an association plan with proven results. Where to start this month? Inventory your affiliations, trade associations, chambers, unions, guilds. Ask each what pooled programs exist and request fee stacks, 5-year rate history, and governance docs. If you're an employer, pull 24 months of claims de-identified, pharmacy top 50, and large claim summaries. Have an actuary run a feasibility check for level funding or a micro-captive. Convene 3 peers. Share renewal dates, losses, and appetite for rules. If there's interest, hire an independent captive manager or benefits attorney for a scoping call. 1 hour clarifies viability. For pharmacy, pilot a pass-through carve-out for maintenance meds with a small cohort. Measure net cost per script and adherence. Expand if the math beats your incumbent. Group power isn't a silver bullet. It's a different game with your hands on the levers. When you buy like an owner, you stop paying retail for friction and start funding your own resilience. The Civic Playbook. Fix the rules that make this a trap. Personal moves by time. Policy fixes change the game. If you want premiums that reflect risk, claims that move on evidence, and financing that doesn't turn coverage gaps into revolving debt, we have to rewrite the incentives. Here's a clean, actionable agenda you can push at City Hall, your State House, your regulator, and your employer's plan committee. Start with junk economics. Ban contingent success fees for municipal insurance advisors and broker of record switches. When consultants only get paid if a sale closes or a rollover happens, you get harmonized prices and fewer options. Require flat fee engagements, publish scopes and fee schedules, and mandate 3 competitive bids for any advisory role over a set dollar threshold. Make appeals transparent. Require every insurer and TPA to publish clinical policy bulletins, prior auth criteria, denial codes, and appeal timelines in plain language. Force them to attach the exact criteria used to any denial and certify specialty match for peer reviews. Miss a statutory deadline? The denial converts to a time-limited approval. Put teeth in it. Automatic penalties remitted to consumers for missed clocks. Cap prior auth drag. Pass response time rules. 72 hours standard, 24 hours urgent. Same day for inpatient concurrent review. Define urgent by clinical standard, not insurer preference. Mandate real-time physician-to-physician access with specialty matching and require audio or video recording of peer reviews on request. Publish quarterly dashboards. approval rates, average days to decision, and overturn rates by service line. Build an independent muscle. Fund an Office of Consumer Health Assistance and a property claim advocate with a policy assessment, so every household has a free, staffed ombuds who can pull files, audit timelines, and escalate to regulators. Give them intervenor status in rate cases and the right to request carrier data under confidentiality. Tighten network adequacy by math, not marketing. Set time and distance standards by specialty, measure appointment wait times, and require secret shopper audits quarterly. If a network fails, freeze denials based on out-of-network status and cap member liability at in-network rates until adequacy is restored. Find plans that report phantom providers. Enforce surprise billing with teeth. Extend protections to ground ambulance and facility-based providers in all settings. Establish binding independent dispute resolution with baseball-style arbitration pegged to median in-network rates and bar balance billing while disputes penned. Require hospitals to give procedure-level good faith estimates with CPT codes and cash/insured prices side by side. Strip pharmacy opacity. Mandate pass-through PBM contracts for any plan receiving state dollars. No spread, 100% rebate return, lowest net cost formularies, and claims-level audit rights. Ban copay accumulator programs so manufacturer assistance counts toward deductibles. Force real-time benefit tools in EHRs that show patient-specific net cost and therapeutically equivalent options. Fix catastrophe cost pass-throughs. Allow limited, time-bound CAT recoup riders only with audited loss data, sunset dates, and public hearings. Require catastrophe mitigation credits, verified roof, wildfire hardening, floodproofing, to be filed and automatically applied midterm. Insurers that deny mitigation evidence must explain in writing with model factors. Rate case sunlight. Publish work papers, loss trend assumptions, reinsurance costs, and expense allocations in machine-readable form. Require consumer advocates with funded experts to cross-examine. Tie allowed returns to service outcomes, leak reduction, claim cycle time, complaint ratios. Missed targets. The allowed return ratchets down automatically until metrics recover. Outlaw deferred interest medical credit traps. Any provider offering point of service. Financing must present a standardized plain language disclosure with APR, total interest, late fee triggers, and a no-interest hospital plan alternative. Ban retroactive interest and acceleration clauses for zero-interest hospital plans. Require 12 to 24-month, interest-free options for balances above a set threshold. Codify continuity of care. When employers change carriers or networks, guarantee transitional coverage for ongoing treatment at in-network rates for a minimum period. Require auto-approval for refills within stability windows and transitional authorizations for surgeries already scheduled. Arm ERISA participants. At the federal level, update regulations so plans must provide full claims files electronically within 30 days, including rule sets, reviewer credentials, and internal communications. Miss it, and participants can proceed to external review. Give the Department of Labor Civil Penalty authority for repeated noncompliance. Regulate vendor lock-in. For TPAs, PBMs, and networks serving public dollars require portability clauses. Standardized data extracts, capped exit fees, and 90-day transition support. Vendors must report ownership changes within 30 days and offer a no-penalty termination window. Set shutoff guardrails. In property, ban water and power shutoffs during extreme heat/cold and for verified medical needs. Require long-term, zero-interest payment plans before liens. For insurance, prohibit policy non-renewals based solely on geography without individualized risk data and a mitigation pathway. Finally, mandate mitigation recognition. Require carriers to file and apply credits for verified risk reduction. Impact-rated roofs, secondary water barriers, defensible space, leak sensors. Allow midterm endorsements to capture credits immediately. Pair this with public grants so low and middle-income households can afford upgrades that lower modeled loss. None of these are moonshots. They're rules that flip incentives from delay, opacity, and extraction to speed, daylight, and value. You can push them through city councils, state insurance departments, benefit committees, and legislative hearings. Bring neighbors, bring bills, and bring one-page proposals that staffers can drop into markup tomorrow. That's how you turn a personal defense into a community shield. The 7-day action plan, rapid wins, and long-term setup. Day 1 to 2. Consolidate everything into one command center. Pull your home, auto, umbrella, and health plan documents, declarations pages, endorsements, prior auth rules, PBM formulary, and 5-year loss runs /CLUE/MVR. Add EOBs for any ongoing medical issues. Create a single cloud folder with subfolders by line of coverage. Take phone photos of your roof, major systems, and valuables. Upload receipts and serial numbers. For health, list current diagnoses, meds, with NDCs, prior auths, and denial letters. Open a tracker sheet with columns: policy, renewal date, deductible, sublimits, exclusions, coinsurance, riders, and broker/carrier contacts. This is your map. Day 3. Market test intelligently. Request bindable, coverage-matched quotes from an independent broker and at least one direct carrier for home/auto/umbrella. Insist on a coverage equivalency grid. Same limits, perils, sublimits, deductibles, endorsements. Send underwriters ammunition. Roof age and material, system upgrades, mitigation, leak sensors, wildfire work, impact-rated roof. For health, employer request your summary plan description and formulary tiering. For individual, price an HSA-eligible plan against your current PPO using total cost math for the upcoming year. If you're an employer, ask your broker for de-identified claims and top 50 pharmacy report. Day 4. Build your health cost map. Call in-network facilities for insured and prompt pay prices on common CPTs you might need this year: imaging, PT, routine labs, colonoscopy. Capture written quotes and ask how they'll submit, so you still get deductible credit if applicable. Save manufacturer copay cards and patient assistance options for any brand meds. Verify cash prices with discount networks. For an upcoming procedure, request the clinical policy bulletin from your plan. Have your doctor map your chart to criteria and calendar prior auth timelines with urgent rules noted. Day 5. Create the claims kit. For property, finalize a photo/video inventory by room with timestamps. Store offsite. Add a template scope in Xactimate-style line items for contractors to fill. For auto, keep a glove box checklist. Photos at scene, police report number, other parties' info, and the claim reporting script. For health, build appeal letter templates that mirror plan criteria with placeholders for ICD/CPT codes, clinician letters, and literature citations. Add a call log template with date, time, name, and commitments. Print one-page first 24 hours guides for each line and stick them in a folder everyone can grab. Day 6. Lock your appeal protocol. For employer health plans, draft an ERISA records request letter, plan documents, entire claim file, guidelines, reviewer credentials, with your plan administrator's address. Save a certified mail label. Outline stage 1, stage 2, and external review timelines on your calendar with alarms. Create a short peer-to-peer script for your doctor. Specialty match requested. Member meets criteria X/Y/Z per policy section 3.2. For property, list your state's claim deadlines and appraisal/mediation options. For pharmacy, script a medical exception request with failed alternatives documented. Make it easy to execute under stress. Day 7. Choose your leverage lane and automate. Decide on your deductible strategy. Raise to the level you can truly fund, then auto-transfer the premium savings into a dedicated deductible and repairs account every payday. Set 120/90/60/30 day renewal reminders and stagger renewals if possible. If you're a small employer, book a feasibility call with an actuary or captive manager using your claims summary. Join a buying group or association plan with transparent fees, pass through PBM and member governance, collect governance docs and 5-year rate history before you commit. If none exist, invite 3 peers to a 30-minute scoping call about a benefits trust or purchasing group. 2 add-ons that pay fast, mitigation with receipts and data hygiene. Schedule impact-rated roof or secondary water barrier estimates. Collect wildfire/wind/flood hardening proofs. Install leak sensors. Ask your agent to submit credits midterm after upgrades. Pull your CLUE/MVR/loss runs. Dispute phantom claims and closed without payment entries, and res hop once corrections land. Bad data is silent surcharge. Fix it early. Finally, set household rules. No point of service financing without a written estimate and a cooling off period. No contractor financing. Scope first, funds second. No medical card deferred interest traps. Use zero-interest hospital plans or your own low-rate line if financing is unavoidable. Every prior auth gets the plan's criteria attached to the request. Every denial gets an on-time appeal with citations, and every missed clock triggers escalation. In 7 days, you've built a binder, proved your risk, priced real alternatives, pre-negotiated care, and wired your calendar to fight. You haven't hacked insurance. You've removed friction, corrected incentives, and set cash aside so a deductible doesn't become debt. Next week, you'll look at the same bills with leverage, and that's the point. The shock-ready household, resilience for the next 12 months. Okay, here's the play for the next 12 months, so a surprise bill or storm doesn't derail you. Think of it as turning everything we set up into a rhythm you can keep. Start with buffers tied to deductibles. Park 1 month of expenses plus your highest single deductible in a separate high-yield savings account labeled shocks. Automate transfers the day after payday, even if it's $50. Each quarter, top it up with any insurance credits, refund checks, or side income. When you raise a deductible to lower premium, increase the auto transfer by that savings amount. You're converting risk into cash on your terms. Rotate your coverage calendar. If all your renewals land in the same month, split them. Move auto to your birthday month, home to 6 months later, umbrella to the quarter before tax season. You want one shopping decision per quarter, not 3 in a week. Put 120/90/60/30-day reminders in your calendar with the exact tasks. Loss runs requested, mitigation proof sent, bindables due. Run quarterly audits. Q1, premiums, deductibles, and riders. Does every line still earn its keep? Q2, networks and formularies. Did your hospital exit? Did a med change tiers? Q3, property endorsements. Are water backup, ordinance or law, and roof settlement still right? Q4, life and disability, plus umbrella limits relative to assets. Each audit is 1 hour with your file and a notepad. Keep, drop, or renegotiate. Disaster-proof documentation. Twice a year, do a 20-minute documentation drill. Walk each room with your phone, narrate items and serial numbers, open closets and drawers. Upload to your cloud folder. Snap the roof from the street, the water shutoff, the breaker panel. Save receipts for roof, HVAC, and mitigation upgrades. Print a contact sheet. Carriers, policy numbers, adjuster emails, doctors, pharmacy, and a claims script. Drop one copy in a plastic sleeve in the kitchen. Store another in your car. Build a go-bag claims kit. A simple folder with copies of IDs, insurance cards, a USB with your inventory, one blank contractor scope template, spare phone charger, a notepad, and a Sharpie. Add 2 contractor business cards you trust, pre-vetted. In a storm or leak, you'll grab this and act fast without signing anything dumb. Do an annual leverage sweep. Freeze your credit with all 3 bureaus to block opportunistic financing offers after a claim. Pull your CLUE and MVR. Dispute. Errors early. If you run a small plan, shop stop loss and PBM once a year. Require pass-through pricing and no laser language. Ask your broker to resubmit mitigation proofs midterm. If you re-roofed or added leak sensors, capture credits now, not next renewal. Bake in health continuity. Maintain a 90-day supply of maintenance meds where allowed. Rotate stock by fill date. Keep an updated medication list with NDCs and prescriber contacts. For any scheduled procedure, pre-book prior auth with policy citations and ask your physician to note urgent if delays risk function. Confirm backup sites of care, alternate imaging center, urgent care with your records. Run household tabletop drills. 2 Saturdays a year, rehearse the first 24 hours of a water leak or outpatient denial. One person calls the carrier and emails the claim number to the family thread. One pulls the go bag and starts photos. One checks shutoffs and moves valuables. For health, rehearse a prior auth call. Ask for the bulletin site criteria, request a specialty match. These 15-minute reps erase panic later. Practice cash discipline. No point of service financing without a written estimate and a 24-hour cooling off rule. If you must finance, you choose the instrument, credit union loan or zero-interest hospital plan with no retroactive interest, not a deferred interest card. Add a standing rule. No contractor financing, scope first, funds second. Keep community ties warm. Swap contact lists with 2 neighbors, share roofers, mitigation vendors, and a spare wet/dry vac. Join your local wildfire, flood, or storm council. Group certifications can unlock mitigation credits. Know one consumer health advocate and your state insurance complaint portal. When a timeline is blown, you escalate in hours, not weeks. 12 months from now, you want 4 things: cash equal to a deductible and a half, staggered renewals with bindables archived, updated inventories and mitigation proofs, and 2 successful drills under your belt. That's resilience you can measure. Insurance is now priced to deny and delay. Your leverage is preparation, documentation, and deadlines you control. If this gave you workable moves, subscribe and share it with one person whose premium jumped this year. Then watch the companion deep dive where I demo the 7-day plan on real policies and show the exact emails and scripts that flip denials.